Hey guys, welcome to another Ultimate Edge webinar series. This time we're pleased to have a couple of people here that I know quite well. Del Fujinaka, who is the owner of Oku Legacy Solutions, which is a financial planning firm. Del's going to explain his role here to you in just a minute. And then Dave Herbst, who you know from CMG Mortgage, who's the all-in-one guru that I chat with a lot. And today's discussion is going to be about using the all-in-one loan as a tool, much like we have talked with our clients that mortgages are all a tool for building financial wealth. Using the all-in-one loan in particular as a tool along with other financial planning tools that clients might have to build wealth. And I can't think of two better people here other than Del and Dave. So with that, Del, why don't you take it off and we'll chat about the financial tool of the all-in-one loan.
Sure. Yeah, so just to bring clarification, financial planning has been very overused, and but yet there's so many. I'll start off with the one word called unbiased. And I used to be a financial advisor for a couple decades and transitioned out, sold my book of business, and really began to study the banking system and the systems. And basically, my transition has been more towards business coaching, growing value in companies, as well as transitions for family estates. And so as I began taking that process of finding out financial tools, and basically from the source of looking at what the largest banks do and being able to mimic them, that's the basis and the goal I had to mimic for my clients, whether family estates or businesses, what they're doing. And I guess that's my opening comment, that as I began to do my due diligence, there's a couple financial tools that I began to position for businesses and family estates. And then all of a sudden I began to see this all-in-one loan, that the uniqueness of the structure, fulfilling the need right now for what they call dry powder or liquidity, just in case, right? Cash is king. So two tools I use, and if you go to my website, delfujinaka.com, you'll know that I'm not a financial advisor anymore, but I'm looking for the unique ways of positioning for the uncertain times ahead of what will be king. And we often hear that cash is king. And to me, it's liquidity. Based on the majority of our world's economy, it's not on the circulation of money, but more on how they're managing debt. And so, the tools I would use, believe it or not, if you look at Bank of America, they have over $22 billion in high cash value life insurance. But it's a very unique way. It's not how they solicit to depositors, because they need the deposits at the bank. So they uniquely design that where it's not so much the debt benefit, it's more asset protection for them, just in case it's insolvent, they go insolvent. But they have this pool of money, that's cash, that's available to for the executives only. Keep in mind, no 401k on the side. They're the executives that they're using for healthcare costs, they're using for tax efficiency, they're using for better yield. And that's one tool that I'm saying, hey, wait a minute. If I can uniquely design a policy that way, the way they do it, all of a sudden I got a good tool in my belt for them as an advisor, right? Cross-grain from what financial advisors talk about, putting together a portfolio, stocks, bonds, and such like that. Now here's the other tool. And I definitely want to dialogue more with Dave on this, and brilliant, where it came from, and the all-in-one loan, but the key is having awareness and education to manage these tools the right way, because it can work totally against us, right? And so I vet out not only the tool in itself, but I vet out literally the client's understanding of using the tool. So Dave, you want to respond to that?
Yeah, I love what you said there, Del. I think oftentimes, as it relates to personal finance, and how households tend to look at their finances and their financial landscape and their trajectory, the liability side of their personal balance sheet is, I think, often overlooked, for lack of a better way to put it. It's really not viewed as an opportunity. Our debts and our expenses are what they are. And I think that in large part, the thinking or the strategy stops short. Um, and I think the focus is traditionally always been, do I have the lowest monthly payment possible, right? And what tends to drive that is interest rates. Do I have the lowest interest rate possible that I can actually achieve today? If not, then refinance um, and achieve the lowest payment that I have. So therefore, I can continue to focus most of my energy on the asset side of my personal balance sheet. But that can also be destructive, right? But I think that's the traditional way of managing things at home. So very little attention paid to the liability side, and much more focus on the asset side, meaning work with a financial advisor, invest, save money, things like that. But I think one of those things that's often just not put in place or used as a strategy is debt reduction itself, not just minimizing your monthly payment, but actually reducing and eliminating the debt altogether. Because if you can achieve that, then obviously you have an easier time bolstering up that asset side of your balance sheet. The big challenge is, especially in the mortgage space, but I would argue with all debt instruments, it's extremely hard to do because mortgage loans, car loans, boat loans, most security instruments used to finance collateral, whatever it may be, are closed ended. They don't create liquidity. They offer very little incentive at all to actually pay down or eliminate the principal more aggressively. That keeps people in debt for longer, which in the end actually costs them more than is necessary, which impacts and acts as an impediment to their wealth growing capabilities. So it's a nasty cycle that people get kind of caught up in, or a rut, if you will. And I think what you're alluding to with the all-in-one as it compares to other mortgage instruments is that it solves that issue. It solves the problem of liquidity. We all know that paying down debt will save us money and time. But how do you do that with a conventional mortgage tool when your money is locked away in it permanently, right? So behaviorally, that means that I'm not incentivized to put any extra funds towards my principal, even though I know that financially that would benefit me. But it also could create some risk because those dollars are locked away and you cannot access them. So, you know, creating an instrument that's what's really recognized as an open-ended or two-way mortgage instrument, otherwise known as a HELOC, to finance real estate with, and acts as your primary mortgage, your first lien position mortgage, now allows borrowers to take greater control of what their principal is and their interest cost, using more than just the payment amount to reduce their principal while they remain liquid. So I think it speaks really well to what you've learned along the way, and the strategies you're putting in place today for your customers.
As a mortgage that you're going to pay into, and there is some incentive, right, to pay it down because you save interest over the long run. But as Dave mentioned, you put a payment into your mortgage and it's a 30 or a 15-year fixed, and it's gone. If you want to get it back, that's cash that you don't have access to later on. And that really can impact your situation when you need to have access to some liquid reserves kind of thing. Hence the all-in-one loan, which is a mortgage, works really well for purchasing, refinancing properties, but combined with some of the stuff that Dale's going to talk about, you have access to it. It can be really, really powerful in a doubly-edged way.
Yeah. And let me add to that really quickly. I think also too that, just to kind of dovetail on everything that you'd mentioned here, Del, I repeat pretty frequently in the coaching opportunities that I have, either with mortgage professionals, real estate agents, financial advisors, fiduciaries in general, and most certainly consumers, that money, as money doesn't disappear. It's transferring, and
Right.
and money is either transferring towards you or towards somebody else, right? And the question then becomes, what am I doing about it? Am I really pursuing the tools and the knowledge to be able to manage my money, so it actually transfers or continues to stay with me and benefit me more so than it does other entities or other people? And I think that's really the key to success. It's you can accomplish both. You can grow your wealth while also eliminating expense or debt in your life. And I think that's what the underlying story here is. I think most of the market has a hard time doing both. They stay in debt forever, and they just focus on growing their retirement funds. But they find themselves at retirement age with 28 years left on their mortgage, and they've got to make some pretty drastic decisions at that point in their life, and that's a real sad thing.
Adding to what Dave said, guys, or you're the client who works really, really hard to pay off that mortgage over time, and you put extra payments into it, and there's a cost to everything, and the cost of that is you're not taking those liquid funds they're using to pay down that mortgage and using them up perhaps over here someplace where you could grow your asset at a greater return than the cost of the mortgage that you're paying down.
And if you can describe it in one thing, when I'm listening to you folks, it really comes down to cash flow management, and it's not about what investments I'm in, but am I positioned the best to manage my cash with different tools that I have at hand? I wrote down here, one, risk management, on the good and bad times. And that's what caused me to make some shifts in my career, because I was looking at, for example, going to the source of a 401k, why it was designed. And Dave mentioned the statement of cash being locked up, and so the narrative of people positioning money there, although I've managed 401ks for companies, the money's locked up. And what's the narrative based on Wall Street and the government? Money's locked up. The unbiased truth about it is we've never paid tax on that money. And when we see opportunity, like, for example, a multifamily home, I can't touch that because that's my retirement money, right? Which is not going to be on the back end. Passive income tax at long-term capital gains rate is going to be taxed at ordinary income tax rate. Because of all the money being printed, because of all the financial decisions, there's more a probability that tax rates are going to go higher. And that's going to be very unfortunate for those who are just fully engaged in, this is my retirement plan, right? And the narrative of saying, I'm getting the break on the front end, but we're still in partnership with the government. But for me, it's along the way, the opportunity, it really comes down to what I was teaching from the past and how I had to reinvent myself unbiasedly. And the statement you made, Dave, about being locked away, I think that poses more risks than not. And so it's a matter of this paradigm being understood by the general public, while the mega high net worth and banks, they understand it. But why aren't they teaching it? That's a simple question. Response to that?
I mean, I think it really comes down to number one, the products, right? I think that there's been a lack of innovation. I can speak, pretty deeply about the mortgage industry, and I love this industry. This industry is, proves over and over again to really support the backbone of our nation. Housing is really the backdrop of really all of our lives. At one point or another, right? And it's probably one of the greatest opportunities for wealth building that there is today. However, the mortgage itself is lacking innovation, or has lacked innovation really over the last 80 to 90 years, since the Great Depression era and the formation of the agencies and HUD and the amortized mortgage programs. I think that's where it really begins, Del, is the lack of innovation over time, and this adoption of this kind of almost one size fits all. It's almost the same like listening to you talk about 401k accounts, how we're all almost being programmed over time slowly to look for the best 401k opportunities at an employer, as being the vehicle. That's my pathway to retirement, and it's almost this one size fits all kind of solution that we've been nearly programmed to embrace and accept as the only way and the right way. And I think along that process, we put on our blinders. But I think the change begins not only with education, but some actual fortitude to actually begin to change the programs, right, and make them available, restructure them, and I think that's a we have to ask ourselves why is there a lack of innovation in these sectors when it comes to personal finance? Why aren't we making it easier for people to actually reduce their debt and retire securely, and be able to manage that and remain liquid while they do it over decades of their life. Why do we make that so hard in our respective industries? I think there's probably an abundance of answers for that, but I'd be interested to get your take on that, actually.
Yeah, I have a couple of points in thinking about it when I'm listening to you. One is simple, with that pegging of a 30-year mortgage and how it was designed. It was amazing for me to discover that for every quality 30-year mortgage, let's say a large bank would do, literally the central banks would 10x their credit. So basically liquidity, right? And I'm thinking, okay, if the banks have that leverage, how can I, with my family estates, who completely, totally paid off their house already, but they're looking to expand more with building stable wealth, and business owners who have their commercial properties, it's really about having that, again, that dry powder, that liquidity. And the biggest thing, I guess the question I would have, and you can speak into this, Steve, is why was there no defaults in the midst of one of the bubbles that took place back in 2008, and you started in 2005? It's really about people having awareness of why there was no defaults. Can you speak into that?
Yes, absolutely. The reason for this is that the structure of the loan is, as you keep alluding to, it keeps a customer liquid. It's structurally, it's a 30-year draw, first lien position, home equity line of credit, which is extraordinary. I really ultimately don't know. There might be a community bank here and there, regionally, that offers something similar, but I'm actually not familiar with any other line of credit that offers 30 years worth of liquidity. So once this is put in place, the customer can access their equity dollars and pay down their principal balance and draw it back up as however they want to over 30 years. The credit limit itself begins to reduce or taper month over month, but not until month 121. So 10 years and 1 month into it, your original line of credit that we set and we closed the loan at originally doesn't alter or shift or modify until the 121st month. And even then, it's an even reduction of the line of credit limit until it reaches zero by year 30. So it's a 240 month tapering of the original line of credit. So it's a slow and steady reduction to enforce a payoff. We don't want this to be a personal line of credit that goes on indefinitely, nor do we want to have a balloon payment due, because that's just, those things are unaffordable. We want this to be a solution to the debt, but provide a lot of access and control and liquidity over a long period of time. So think about how that may impact as you take on a financial challenge. And then many millions of people today are experiencing that all over again, unfortunately. But imagine having access to your home's equity dollars up to maybe 80% of its value from 5 years ago. But now you've suffered some income loss, or maybe you're on furlough today, right? Temporarily. Well, imagine being able to tap back into your home's equity just by swiping an ATM card or writing checks and paying your bills from that equity line until you get back on your feet. So this is the real answer to your question. This is why we have no delinquencies and no defaults on the loan since inception, because it provides that fluidity, that liquidity, and access to equity dollars. It's not a leveraging tool. It's a deleveraging tool. But as you deleverage, you're creating financial security that you can leverage if in case life throws you a curveball down the road. And we know it does, right? We go through these cycles about every 8 to 12 years, it seems, where that extra support is needed. So in a sense, kind of think about it this way. What if you had access to all of your previous mortgage payments, right? And you could access those funds right back out because you need them today to pay your water bill, or to just pay your other bills for a while. That'd be a great thing. What if you weren't reported delinquent or default on that, and didn't default on that loan? So that's this. It provides that kind of security to be able to manage and maneuver through those financially challenging times.
So do you see any of your clients utilizing the forbearance provision in the CARES Act right now?
We don't. I mean, we've had we've certainly been contacted by some folks that have either voluntarily gone on furlough or been furloughed from their job. but these are also folks that have, you know, equity dollars available. And so, you know, we've had some people that have explored, you know, what it might mean if they're unemployed for an extended period of time. But it's a very, very, you know, minimal amount of folks that have actually, with the loan, that have actually contacted us on that. You know, it's that security blanket is already built into the product. So really, it's not been an issue at all. Whereas, you know, on a conventional mortgage, you're 90 days away from defaulting, right?
That's
We
right.
know that. And, you know, this conversation reminds me of something I heard, and I'm going to paraphrase this. I'll probably make a mess of it, but I remember traveling somewhere, and I was in a car, and I had a long drive ahead of me to an event. And I remember listening to Dave Ramsey, actually, and just flipping through the radio, trying to find something I could listen to for an hour or two. And I remember listening to Dave Ramsey talk to a caller about the reasons why you'd want to eliminate mortgage debt. And it's just kind of funny. It stuck in my head because it was funny. And the caller had just simply asked, why would I want to do this? I've got a low rate mortgage. Isn't there better ways to utilize my extra cash? And Dave just responded. He said one word: risk. And Del, you kind of opened up with that. You know, risk is a part of it. Risk is a major part of this. The other thing that he said was, because it was silent on the call for just a second, and Dave, you know, felt the need to kind of explain what he meant by that. And so he said, 100%. Again, I'm paraphrasing, but he said 100% of foreclosures have occurred on households with a mortgage. And that's kind of funny because, of course, that's the only way you can foreclose, right? Is if you're unable to afford the mortgage. But it comes to risk. It comes down to risk. If you're mitigating that risk by eliminating the debt faster, and you have a vehicle that allows you to do that while you remain liquid, then really it's the best of both worlds. You're eliminating interest cost, you're eliminating that risk, you're creating greater cash flow and security for yourself. It's an enormous, you know, instrument for people that can manage their cash flow well.
You know, I want to add to that, guys. Dave and I did a webinar, it's been ages back, where I asked him to give real world examples of people who had the all-in-one loan and how it had impacted them. And one of the ones, Dave, you mentioned, which really stuck out to me at that time, speaking of managing risk, is the self-employed borrower who oftentimes has variable times of income. And there were some self-employed borrower wrote in, or I'm not sure if they were self-employed, but they had lost their income for a period of time for whatever reason. But it didn't impact their mortgage payment one tiny bit because they had a lot of equity that they had created with the all-in-one loan in their home, which allowed them to make the interest-only payments because it's an automatic payment mechanism with the loan, and get through that period of time when they didn't have that income that they normally needed. And then they recovered and got their income and got back on track with no default and no late payments on their mortgage. It's just kind of a maximum flexible situation and a tool that allows for that and creates that.
Yeah. I've got a question for you, Del. Do you find, especially in your industry, and as you coach just regular everyday people about you know, some strategies and building cash flow and utilizing their cash flow, I think, more effectively, do you find that this, you know, those conversations are somewhat new? Like people, I find that a lot of people don't really understand the power of their own earnings, right? We tend to think of our income as you know, we've got it in our possession temporarily, but most of it's already spoken for, right? I think most of us walk around feeling like we really don't have a lot, when in effect we actually do. Most people will earn more in 5 or 10 years than they actually own their house. It's about how you utilize that cash flow. So do you find it easy or hard to kind of coach people through that and get them kind of create that self-awareness of their own abilities with their cash? What's that like for you?
I think that process in itself, even though the tools that I use are so powerful, it's allowing them to develop their own convictions and the paradigm of really managing cash flow. I mean, if I look at from you know, my financial advisor experience, and I'm looking at the timeline, the largest expenses, there would be better ways if they would have access to their own liquidity to pay off a home or education. Or so I literally have it all laid out, and I was stuck because I'm telling them, you know, to pump money in to put away for retirement and establish this three-legged stool where Social Security and your pension and 401k will be it. But in reality, that was not the whole truth. So to answer you on managing that cash is something so key, but to have people absorb and understand and develop their own conviction is taking some time. And that's why I'm investing a whole lot proactively on having that paradigm be solidified, and that simulator that really helped, to show, because, and still, just in recent appointments, they say, no, that's too good to be true. They're thinking that, okay, the lender is in New Zealand. No, that it originated from New Zealand. It's over here. It's been around for years, right? And it's really all about the structure. Same as I was open enough to dive into certain structures in life insurance policies because banks had it, but it's all in the structure. But the biggest challenge would be now the next step, buy-in. They understand, wait a minute, we're advocates for them in managing their cash. Because really at the end of the day, especially what we're headed into, it's liquidity in good times and bad.
Yeah, absolutely. As I explain it, debt specifically, and this is really something we've learned to illustrate as part of the original, concept beginnings with us and with our founder and president, Christopher George, who really innovated this in his mind after being exposed to similar products in Australia. We used to use this illustration that we used to refer to as piles and holes. And that it's a good illustration to use because obviously one's a positive, one's a negative. When you borrow money, you're in deficit, right? You're in a hole. And of course, most Americans have several different holes, their mortgage being the biggest hole that they have. And car loans, student loans, consumer debt, credit card debt, things like that. They're all little holes or big holes that you're being charged interest on. And in the meanwhile, you've also got this pile, which represents your flow of money, your flow of cash, your earnings over time. And of course, that pile of money ebbs and flows in size with your deposits and your withdrawals. But that's generally speaking where we manage our money from, right? That pile. Why? Right. Because it has some security with it. It has access to it. It's a temporary holding place for it in this pile. And we become used to managing our money that way. And from that pile, we make payments towards the holes. The downside is that all of those holes are structured with amortized repayment schedules to where very little of my money is going towards principal to fill the hole up and reduce my interest cost. In fact, all those holes, including a mortgage, computes interest only once based on your original balance, principal that you borrowed. It doesn't recalculate interest as you pay down. So if you're looking to save money, you've got to fill up the holes faster. It's really no secret. So the illustration we used to use as we coached and kind of educated on this program was all we've done is combine the pile with the hole. The access features, the security, the liquidity, the access to your funds 24/7, and all the features just embedded into the hole, into the mortgage itself. Something really peculiar happens now. Now your hole is filling up faster, for lack of a better way to put it, right? And you're being charged less interest because you're filling that up. It's like putting a fire hose to it versus just using a garden hose, right? You're going to fill it up faster using your earnings while you remain liquid, and that creates substantial opportunity because what you don't spend in cost and interest expense helps you compound your savings, and that creates a high level of optionality to go use those funds towards investing and securing other areas, right, of your financial landscape. So it just I think a lot of times the barrier is keeping it really simple and making sure people kind of look at things this way in the simplified format to begin to realize how powerful their cash flow actually is.
I can add to that. I'm thinking about that one term that banks would use is called velocity of money. And that velocity of money approach, I'm all for guys crushing their mortgage and paying it all off. But once, when I'm talking to accredited investors and they're a little bit more sophisticated now, they know that this tool can crush the mortgage and they do pay it off. They have options at least, right? Whether to get passive income if they've used a part of this line of credit to go into a multifamily home. and they're getting a good pricing on it, good structure, and the net operating income is really positive for them. Okay, then again, it's just a way that whichever way they want to go, that's what I love about it. The tools are there where it's because of not leveraging, but paying down through the power of more principal. By the way, that's what the banks do with the BOLIs. That's bank-owned life insurance, and that's how I specifically designed it to finance stuff with what I call a legacy bank. It's really under-promising and over-performing in the good and bad times. And that's another question I had for you, Dave, on the caps. I don't know, in the past, if you remember that, I would find out, okay, what is the cap, the just in case, right? In the chaos or hyperinflation or such. What is the cap on the all-in-one loan?
Yeah, so our cap is based on the greater of the floor rate, which is 3.75% today, or the initial fully indexed rate plus 6%. Okay, so let me repeat that again. It's 6% over the greater of the floor rate or the initial fully indexed rate. The fully indexed rate equals two components. The baseline index that we use on this loan is the 1 month LIBOR today. And then the customer chooses a margin as well. We've got several different options for them to choose from. And pricing, closing costs are associated with which margin they choose. And every margin out there that we offer is very competitive at a fully indexed with the LIBOR index is very competitive to conventional mortgages today. But our rate cannot go lower. The fully indexed rate cannot go lower than the floor rate, again, which is 3.75. So again, the lifetime cap is 6% over either the floor or the fully indexed rate, whichever is greater. That would equal about 9.75 to 10, call it 9.8 right now. So as a lifetime cap. And I think your underlying question is, should a consumer, look at that as being a risk, having a lifetime cap on an adjustable rate mortgage at that level? And yes, of course, it's about measuring risk and understanding, the upside, the cost benefit, and the potential risk associated with rates increasing. Of course, the index itself would have to increase by, call it about 600 basis points, right? Pretty significantly. And the LIBOR, we chose the LIBOR index because it tracks nearly identically with our federal funds rate, which is down at the targeted at about 0 to 0.25%. So LIBOR is that low too. So that means the Fed in a hyperinflationary environment would have to obviously increase the overnight rate up pretty significantly and dramatically to reach that level. That's not an overnight thing. Could it ever happen? For sure. Nobody's got a crystal ball. Right. But I also think you would agree, Del, that especially with your financial background and everything you analyzed today, that for that to happen, some significant changes would need to occur. It's not just inflation and the spread of money, but it's also the pay down of debt, national debt, right? That landscape would likely have to change dramatically as well. Right. And also the global economic landscape. There's right. So much pressure for us to keep our overnight rates really low to compete and continue to make debt affordable. So, but you mentioned our interactive simulator a little bit ago, and that's exactly where we take people right to that to analyze whether or not, if in a rising rate environment, you possess enough cash flow and positive cash flow behavior to hedge that risk. It's all about the math.
Right. And it's really not about the interest rate. It's more about the effective rate that I've witnessed, right? And that's the component that several of my clients missed. They were trying to do it on their own, and they're having the mindset of a 30-year mortgage. So instead of $900 a month, my max is $1,220 a month. But they're not looking at using their whole cash flow as a circulation method, right?
Yep. Yeah, and in the simulator, it measures that comparison effective rate, right? So In many cases, it's below, 1.5%. So in other words, to gain the same savings benefits, one might have to go try to achieve a 1.5% 30-year fixed loan, and of course that's not available today. And we've got 200 basis points or more to get to that level. If it goes to that level, I don't believe it will. But so yeah, there's an effective rate measurement in our interactive simulator, and that's pretty opening for people. There's also a break-even rate where it also indicates how high the all-in-one loan rate would need to average to cost the same as that conventional mortgage. So, and oftentimes that's well beyond the cap. So in other words, if the break-even rate is 18%, but your cap is set at 9.75, given your cash flow, even if the rate were to drive up to its cap, you're still better off financially, right, than compared to a traditional mortgage in that example. So it's all about measuring risk and benefit and making sure that this is the right product for the right household, given their banking behavior, but providing the security and the optionality to use it and leverage money and deleverage and leverage and deleverage and really maneuver over a pretty lengthy period of time.
Great stuff, guys. Thank you very much.
Thank you, John.
Thanks,
So,
John.
Dale Fujinaka, he's the principal owner of a company called Oku Legacy Solutions in Hawaii. Dale, I'm going to have your contact information up on the screen. Thanks for joining us today. Appreciate that. Dave Herbst, Vice President of CMG Mortgage. Thanks again, Dave, for joining us. And those of you know that if you want to have a question on all-in-one loan, Dave's not the great guy to call. He's the Vice President of the bank. If you have questions on a loan, give myself or a loan officer that knows the loan and can do it a call, and we'll happily answer those questions for you. So once again, guys, thank you for your time today. It was a good one. I really learned a lot, and it was fun listening to you guys dialogue here.
John, thanks for having me. I always appreciate it.
Thanks, guys. Really appreciate it too.
All right. Bye-bye.